No, good afternoon, everyone, and welcome to this webinar on how banks are coping with climate change. I am Marina Finken. I'm the Making Finance Work for Africa Partnership Coordinator, and on behalf of all the partners organizing and convening these webinars, I want to wish you a very warm welcome and thank you for joining this webinar. The partner are Global Center on Adaptation, Making Finance Work for Africa Secretariat, UNEP FI, the African Development Bank, and the AFAC initiative. So this is the second part of a series of webinars we are convening on the climate change and the African financial sector. We kick off this survey last week, and I'm very happy to recognize many names from the session we had last week. Indeed, we discussed during a 1-hour session the impact of the climate change on the African financial sector in general. And in this session, we remind the urgent need for Africa to adapt to the worsening effect of the climate change. We also remind the important role that the African financial sector has to play in supporting this adaptation and the investment opportunities that these represent for the African financial institutions. The first webinar last week was also the opportunity to introduce the AFAC initiative, which was launched by the African Development Bank in recognition of the fact that the African financial sector needs support to endorse its role in the adaptation to climate change and take fully advantage of the existing opportunities. Today, we will focus on African banking groups, which represent the bulk of the African financial sector. So before we start, please let me remind quickly some housekeeping rules. So we will be together for an hour and a half, including question and answer. So all participant microphones are disabled now, and we will please ask you to let them so during the entire session for better listening comfort. As usual, we will have the opportunity to submit questions. So we will have a Q&A session. We will see that later on the outline. And you can do so either by writing your question via the Q&A button or by raising your hand during the Q&A session. Also, the webinar is available in French or in English. You have the option to choose the language you prefer using the interpretation button that you may see at the bottom of your screen. We will share with you the presentation and the recording of the webinar within 72 hours following the webinar. And they will also be available on our Making Finance Work for Africa website. If you encounter any technical issue, please send a message to the organizer and we will do our best to resolve it. And as usual, please, a satisfaction questionnaire will appear automatically on your screen at the end of the webinar. And we'll ask them to take some time to complete them. So if you move to the next slide to see the outline of the webinar. So as I said, I'm Marina Finken, and I will give the floor very shortly to Dr. Dorsuma, Manager Climate and Green Core Division within AfDB for an introduction remarks. If we move to the next slide, as I said, we will be together for an hour and a half. So we will start the presentation after Dr. Dorsuma opening remark. We will have a presentation from Sarah Kimmich, UNEP FI, where she will give us some insight on how African banks are actually coping with climate change. After that, we will have a panel discussion with the panelists I will introduce later, the Q&A session, and the closing remarks. We also want to have the opportunity to hear from your own experience and your feedback on the subject. So during the presentation and the panel discussion, you will see appear on your screen some survey questions. We invite you to respond to them, and we will share the result of discussion during the webinar. Finally, before giving the floor to Dr. Dorsuma, I want to quickly welcome and introduce our panelists today. Which will appear on the next slide, please. So Sarah Kimmich, Lead Secretariat from Net Zero Banking Alliance within UNEP FI. And we will also have during the panel discussion the opportunity to hear from the experience, director of experience, from Mrs. Judith C.G. Ochambo, Head of Corporate and Regulatory Affairs at Kisubico, Mr. David Ashabo, Chief Financial Sector Strategy Officer at the African Development Bank, and Mr. John Boateng Akukotawa, Head of ESG and Climate Finance at the Development Bank of Ghana. So again, thank you very much for joining us today. And I will leave the floor now to Dr. Dosoma for the opening remarks.
Thank you. Can you hear me?
We can hear you very well, Dr. Dosoma.
Okay. Thank you very much, Marina, for the opening remarks. Let me also add my voice to yours to welcome our distinguished participants to this very important webinar. Dear colleagues, financial sector executives, our partner institutions within the African Financial Alliance on Climate Change, AFAC, AfDB staff, and colleagues from other development organizations, ladies and gentlemen. On behalf of the African Development Bank, let me first thank you for honoring our invitation to this second out of a series of 5 webinars. Last week's webinar examined climate and its implications for the African financial sector. Today's webinar zooms in on the implication of climate change for Africa's banking sector. I therefore take this opportunity to thank colleagues from the African Development Bank, the Secretariat for Making Finance Work for Africa, the Global Center on Adaptation, and the United Nations Environment Programme Financial Initiative, UNEP FI, for organizing this event. Ladies and gentlemen, last week, we discussed at length the existential threat climate change poses to African countries. And despite contributing less than 3% of historical global emissions, Africa is the most vulnerable region to climate change. And to date, the pledge by the global community to contribute $100 billion per year in climate finance to countries in the global south is yet to be fully met. Therefore, many countries, particularly in Africa, are left to bear the brunt of meeting their climate commitments on their own. As Africa's largest development finance institution, the African Development Bank is playing its part in meeting the climate finance gap on the continent. The bank has committed to investing $25 billion in climate finance by 2025. We have been the first multilateral development bank to meet and exceed the global parity between adaptation finance and mitigation finance by exceeding 50% climate financing towards climate adaptation. Nevertheless, Africa's financing gap remains large because the continent still needs about 1.4 trillion on average between 2020 to 2030 to implement its climate action commitments. This presents a potential investment opportunity for African banks, particularly in sectors they already know very well, including energy and transport. To materialize actual investment from the potential, banks must become aware of climate change opportunities while simultaneously managing the financial risk. Moody's projected that environmental factors will lead to a deterioration of the bank's credit quality and profitability in the longer term if banks do not take measures to manage climate-related and environmental risk prudently. 80% of regulators in a recent survey consider climate risk a high or very high priority and consider this risk as part of their mandate. However, only a few of them have published regulations on climate risk management practices. Similarly, 75% of banks are aware that having climate strategies and principles is critical to reducing reputational financial risk associated with climate change. And 84% recognize that a formal climate strategy can open new opportunities. However, only 17% of banks have introduced specific green financing products, accounting for only 2 to 20% of their portfolio. The African financial sector must be supported at all levels. Public authorities, regulators, and financial institutions to understand and manage climate risk effectively and offer products enabling the real sector to take full advantage of climate adaptation and mitigation opportunities. Ladies and gentlemen, it is for these reasons that the African Development Bank has established in 2018 the African Financial Alliance on Climate Change, AFAC. This is a platform for Africa's financial sector that seeks to de-risk and direct capital flows towards low carbon and climate resilient investments on the continent. This vision will be achieved by knowledge sharing, access to data, developing appropriate regulations and tools to manage climate risk, and crucially, mobilizing green finance and fostering industry peer-to-peer exchanges. AFAC complements existing global initiatives with similar objectives. Fundamentally, AFAC aims to ensure that the voice of Africa's financial industry is heard in the evolving international discourse on climate change. In closing, let me reiterate that the financial relevance of climate change is beyond doubt. That is why we developed this webinar series on climate change and the financial sector with our partners. This series aims to foster a shared understanding of the issues at the intersection of climate change and finance. Today's webinar is the second in this 5-part series. During this session, we'll explore how African banks are addressing climate challenges and taking advantage of the opportunities. We will also discuss how the African Financial Alliance on Climate Change can support African banks on their climate journey. I invite the banks and bankers associations represented here to join AFAC and participate in its working group on banks. Details of how to do so will be provided during the session. Thank you very much for your kind attention. Over to you, Marina.
Thank you very much, Dr. Doussouma. We can then move to the content presentation with Sarah Kemet, lead Secretariat of the Net Zero Banking Alliance in UNEP FI. Sarah, the floor is yours.
Thank you. Good morning or good afternoon to everybody, and thank you so much for the invitation to come and speak to you today. So I'll talk for about 20 minutes before we move on to a panel discussion. And what I'll do is I'll first introduce to you a couple of initiatives that are convened by UNEP FI, the Principles for Responsible Banking, which I call the PRB, and the Net Zero Banking Alliance, which sometimes I call NZBA. And so I'll just explain their relationship to each other and a little bit about their membership and the commitments. Secondly, I'll go on to talk a little bit about mitigation and then adaptation. And then thirdly, I'll just come on to talk a little bit about some of the barriers and the issues faced by banks in Africa. And lastly, I'll try and end on a positive note with a few opportunities. I'll be running through the slides quite quickly. I've probably got too much information on the slides, but don't worry about taking notes. The slides will be shared with you afterwards. So starting with the Principles for Responsible Banking, the PRB, it's a commitment that's made by over 320 banks globally, and it covers the Sustainable Development Goals in its broadest sense. Whereas the Net Zero Banking Alliance is a commitment that's specifically focused on climate mitigation. We have 129 members. About 80% of our members in the Net Zero Banking Alliance are also members of the PRB. And members of the PRB commit to conducting an impact assessment of their portfolio and selecting 2 impact areas in which they will set targets within 4 years of signing up. So if they were to select climate mitigation as one of those impact areas, they can then, if they wish to, sign up to the Net Zero Banking Alliance, which hopefully will accelerate their progress, and setting targets under their NISBA commitment will fulfill their PRB commitment on climate mitigation. So on this slide, it shows the membership across the globe of the 2 alliances. So in the round circles, we have the membership of the Net Zero Banking Alliance, and in the rectangles, we have the membership of the PRB. And what we can see here is the way that things sit for Africa and the Middle East region is that we have quite good representation on the principles for responsible banking. So we have 15 members from sub-Saharan Africa and 14 members from the MENA region within the PRB, but within the Net Zero Banking Alliance, we actually only have 4 members across the whole of the Africa and Middle East region. And I think there are a number of reasons for that, which hopefully will become clear when we come to talking about some of the challenges. You can see we've had a really steady growth in the growth of the Net Zero Banking Alliance signatories. We started with 43 founding signatories. We then had quite a good blip in increased membership around COP26, and since then we've just had a steady trickle of banks signing up to the Net Zero Banking Alliance, so to bring us up to 129 members, as I said. So if we move to the next slide, this gives you some more information. Like I say, don't worry, don't take notes. The slides will come to you afterwards. We have the 29 African and Middle East banks in the PRB, and 4 of these have signed up to the Net Zero Banking Alliance. They're highlighted there in orange. So that's CIB, First Abu Dhabi Bank, Investec, and KCB. And moving on to the next slide, I wanted to talk a little bit about some of the impact areas that have been selected by the Principles for Responsible Banking members. So on the left pie chart, we see what the global membership has selected for their impact areas in which they're going to set targets. And on the right-hand side, we see the impact areas selected by the Africa and Middle East members. We can see that in both cases, and I should say these numbers are percentages rather than numbers of members, we can see that climate mitigation is by far the biggest, most important impact areas that banks select, although it is selected by a smaller proportion of banks in Africa and the Middle East compared to the global membership. It's also interesting that none of the banks in Africa and Middle East have selected biodiversity as one of their key impact areas. I suspect that that's more to do with the difficulties faced by actually setting targets on biodiversity yet. There's still quite a journey to go on there for banks to be able to really understand how to be setting targets on biodiversity. But in Africa and the Middle East, financial health and inclusion and gender equality are selected more frequently than they are from the global membership. The other thing that's noteworthy here is that only 3% of Africa and Middle East banks have selected climate adaptation as an impact area. And again, we can come on to talk a little bit about why the reasons for that might be. So moving on to the next slide, I'll just talk a little bit about mitigation now. This slide shows the climate action tracker on the right-hand side, which basically shows that we are, we are really headed at the moment in terms of stated policies and actions for a 2.7 degree rise in temperature above pre-industrial levels. Now that is going to be pretty catastrophic. The Net Zero Banking Alliance is still holding on to the ambition for a 1.5 degree temperature rise and limiting emissions to fall within that carbon budget. On the left-hand side, there's another thermometer from somewhere else. So this was from MSCI, showing that listed companies are also on a path to warm the planet by 2.7. So that really fits with the kind of the policy analysis that was done by the other organizations. So this is not good news. Now, getting the world on track for 1.5 degree global warming really requires a surge in annual investment in clean energy, and we need around $4 trillion a year to be invested by 2030. Now, about 70% of that additional spending that is needed to close the gap between the announced pledges scenario and a 1.5 degree net zero scenario is needed in the emerging market and developing economies. So, you know, Africa has a real kind of outsized role to play there in terms of the investment that's needed. And really the fastest way to get on track for a 1.5 alignment is focusing on decarbonising energy systems. Now, I'll just come on to talk about some of the targets that we're seeing. So if we go to the next slide, how are we seeing banks respond to this? So we are seeing that targets are being set. There's quite a range of different types of targets. So the first box is all about green financing. And so an example of that is ABSA Bank. They have set a target for financing wind and solar of 100 billion by 2025, and also a target within that specifically for renewable power. And what they're aiming for is a compound annual growth rate of 26% in their green financing, wind and solar, by 2025. KCB also have some green lending targets. We may hear from Judith later. So they're looking to increase their green loan portfolio to 25% by 2025. From a current level of 13%, and that's in their Kenya and Rwanda portfolios, and they're looking to look at other subsidiaries throughout their activities to enhance to calculate their green lending portfolio. The second type of target that we're seeing is exposure. So what exposure does the bank have to a particular sector or a particular asset class? And so, for example, Standard Bank has sustainable finance targets, including for renewable energy. And there are exposure targets in terms of percentage exposures to reduce those for gas, oil, and thermal coal. The third type of target that we see is a phase-out target. So an example of this is Investec, who has set a plan to reduce exposure to coal to zero within 3 to 5 years. So that's a kind of phase-out target. And then coming on to financed emissions. So there are two types of financed emissions targets. You can either set these on an absolute emissions basis or or an emissions intensity basis. And a good example of this is First Abu Dhabi Bank. They have set financed emissions targets in line with the IEA net zero equivalent 2050 scenario on oil and gas, power generation and aviation. So they've measured their financed emissions, identified some key levers to achieve the targets and the limitations that they have. KCB has also been really busy calculating their scope 3 emissions for 3 sectors and are in the process of setting targets. And then just to say also that targets can be set on a portfolio basis or for a particular sector or for a particular asset class. And we're seeing all kinds of permutations of these different targets coming out from our banks that we work with. So moving on to the next slide, this just gives you a little bit more information about the Net Zero Banking Alliance. So within NISBA, we actually we require the members to set emissions-based targets. So they can be set on an intensity basis or an absolute emissions basis. But the focus is really on decarbonising the portfolio. So banks must set credible science-based scenarios using low or no overshoot. They must cover 9 carbon-intensive, high-emitting sectors. Their targets must cover a significant majority of their financed emissions, and then they must report on their targets and provide plans for how they expect to meet their targets, and report on the progress every year against their targets. And the reporting has to be of absolute emissions and emissions intensity. And then every 5 years at a minimum, the targets must be reviewed to keep up with scientific and policy developments. So it's a kind of going to be a very iterative process. There's going to be, targets set at a minimum of every 5 years going out to 2050. And this is all outlined in our guidelines for climate target setting for banks. And moving on to the next slide, one question that we do get is, why does the Net Zero Banking Alliance really insist on the setting of emissions-based targets? That is because it's all very well doing a lot of green financing, but if you're also doing a lot of financing of polluting activities, we do run the risk of not meeting our reduction emission targets overall. So the Net Zero Banking Alliance is really focused on impact. And if we fail to actually reduce emissions, then we fail to kind of mitigate this cycle of risk that's that's displayed here on this slide. So moving to the next slide on adaptation, there's a nice picture here of the establishment of some mangroves, which is a very useful adaptation technique in many areas of the world. Only 1% of banks globally and about 10% of PRB banks in Africa and Middle East have identified climate adaptation as an impact area. And, despite clear evidence of real worsening physical impacts, especially in Africa, as we heard earlier. So, so far, no banks have actually set adaptation targets. So what are we doing at UNEP FI to kind of help that? In 2022, we did a study to capture the state of the art work on adaptation. So we published this report called Adapting to a New Climate. And there are some really good case studies and deep dives in there. So I would encourage you to have a look at that. And this year in 2023, we've got a working group of around 30 banks that are coming together to develop guidance on setting targets for climate adaptation. So this is all new ground. And if we go on to the next slide, please. Sorry, and the next one. Sorry, that's got the detail of the report on that slide. So yeah, as you know, adaptation is really required to minimize the risk faced by climate change that's not going to be mitigated. So we've already had 1.1 degree of warming. This diagram is taken from the latest IPCC report. We know that a world at 1.5 degrees is going to be very challenging. But as we talked about before, if we're heading towards something like 2.7, this causes real problems for things like the annual hottest day temperature, soil moisture, and precipitation patterns, etc. So this is a really serious challenge that we face. Moving to the next slide. So we know that there is a massive adaptation financing gap. There are some statistics here. So The estimates vary, but we know that hundreds of billions of dollars are needed every year out to 2050. Nevertheless, actually the table on the top right-hand side shows that it's quite a small proportion of GDP, less than 1% of GDP that's needed to be spent on this, but it's absolutely crucial, and we are seeing a real deficit. So where are the sources of this funding? So obviously there are multilateral adaptation funds, there are bilateral adaptation finance providers, and there's also domestic sources of finance for adaptation. And we can see from some reports that over 60% of adaptation actions in South Africa and about 20% of those in Kenya were domestically funded. So I think we can't restrict our view to one source of funding for this. We need to try and bring in funding from every possible avenue. So moving to the next slide, what are the barriers faced by African banks when they come to setting targets for climate mitigation and adaptation? Well, firstly, there is a real lack of clients' data. So as a bank, you need to know your clients' emissions, and for a development bank, you need to know the bank's financed emissions, where you're lending to banks that are intermediating lending. So it's a very complex chain of data that's needed across real economy value chains and financial value chains. And at the moment, that data infrastructure is not sufficiently good. There's also a lack of country-specific emissions factors for many countries. And at a country level, we're really lacking the pathways and at a sectoral level that we need for 1.5 degree alignment. There's also a real lack of capacity and skills and difficulty in obtaining good consultancy services. That's on mitigation. On adaptation, I would say we're at a much more fundamental level. There's a real lack of accepted measurement approaches and KPIs. So the adaptation is really kind of following up behind on mitigation. In terms of the issues faced by banks on climate change mitigation and adaptation, I'd say there's the financing gap. We know all about that. It's huge. International adaptation financing is about 5 to 10 times below what's needed, and the gap is widening, not closing. There's also an issue that sometimes adaptation that reduces risk is not necessarily inclusive. So sometimes technologies are not available to everybody that needs them or could benefit from them. And often frontline communities have been really underrepresented or underserved in resiliency efforts. So that's a real kind of something that we all need to keep in mind. There's also been a huge amount of competing priorities with the pandemic, inflation, the implications of the war for energy security, etc., and the very high cost of capital. There are also policy and regulatory reforms that are needed, and there's a lot of thinking going on at the moment about the modernisation of the Bretton Woods institutions. So I'm going to in about 1 minute, I'm going to run through 4 kind of opportunities. So I would say that one opportunity that we have is to leverage the might of the Glasgow Finance Alliance for Net Zero. So the Net Zero Banking Alliance is part of GFANZ. GFANZ has 8 financial sector net zero alliances, and it has convened a sector working group to support the development of the Egypt Nexus for Water, Food and Energy country platform. They've also established an Africa regional network, which will support African institutions with the transition journey to net zero. So members of the Net Zero Banking Alliance are automatically part of GFANZ. So, there's a huge opportunity there. Moving on to the next slide, I would say a huge opportunity for Africa is that you have many of the ingredients for clean tech. So when it comes to many of the minerals like lithium, cobalt, nickel, you're very, very resource rich continent, but maybe, you know, some of the way that mining is done has to change how it's been done in order to really maximize on the benefits for that. You know, many activists who work with communities in Africa really fear that far from benefiting from this mineral wealth, you know, there could be a steep price for their extraction. Moving on to the next slide, there is a key opportunity to enhance efficiency. So this diagram shows that the private unlisted assets in Africa are very carbon intensive, but the actual absolute emissions are very low because there isn't the volume of those assets at work. So there's a massive opportunity to chart a new lower emissions pathway for development. And last but not least, if we move to the next slide, there's a real opportunity to mobilize private capital. I mean, we could have spoken for half an hour just on this topic. We can see on here, there's a statistics that only 3.6% of global pension assets were invested in emerging markets in 2018. There's a massive opportunity to have blended finance instruments to overcome this risk return issue that makes the investment unattractive, and higher mobilization ratios in terms of the leverage of the public finance can be achieved by selecting the best blending instrument that really most directly addresses the underlying obstacles. So I'm going to skip the next slide and I'll stop my presentation there. I'll be taking questions along with the panel after our panel discussion. So if we could move forward to our first polling question. So our first poll, hopefully it'll pop up for you, is how well do you understand climate change so far? This is just to gauge, I'll gauge the response of the audience. So let's just give it a few seconds for you to answer. Do you feel that you understand climate change and the implication for banks? Very well, moderately well, somewhat well, or not well at all? Just give it a couple of seconds. And then if we go to the responses.
Thank you, sir. Just taking the opportunity to remind all the participants that they can write their question using the Q&A button, and we will answer them after, just as I said, after the panel discussion. But feel free to already write your questions.
Okay, well, this is quite encouraging. This is, yeah, this is a very encouraging response that the majority of the audience, and I'm just looking at the size of the audience, we've got over 200 people on the call. The majority, nearly 40%, understand the implications of climate on banks moderately well, and 30% very well. So that's really good. That I think if we'd done this question a couple of years ago, the answer would have been very much skewed towards the lower end. So that's really good. Okay. So shall we move forward now to introduce the panel?
Yes, Sarah, please go ahead with the panelist introduction and then the panel discussion. Thank you for the very insightful presentation.
Thanks, Marina. So great pleasure. We now have a panel discussion. So I think they were introduced earlier, but I'll just reiterate. So we have Judith Sidi Odhiambo from KCB. We have John Boateng Akwoko Tawea from the Development Bank of Ghana, and we have David Ashiabo from the African Development Bank Group. So maybe shall we stop displaying the slides while we have this discussion, maybe? Thanks. So Judith, let me start with you. So climate change and climate policy affect the balance sheets and business models of banks in really different ways. What's been the main impact on your institution?
Thank you all, and greetings to each one of us. So what I would say is that for climate change and also in terms of our balance sheet, most of the time what we look at is what are the special considerations that we give in terms of risks and opportunities that reshape our financial landscape. So what we see is that financial institutions face a range of risks from the effects of climate change, and this includes physical, economic, and regulatory risks. And the main impact on our institution has been the risk of non-performing loans due to climate change. In Africa, because also in Kenya, we are a very agricultural country, and our consumers normally, of course, rely on weather in terms of their day-to-day livelihoods. We have also erratic weather. Sometimes the weather patterns tend to change from time to time. And this can also sometimes lead to crop losses, or farmers are not able to harvest on time. And therefore we find customers then unable to repay their facilities if they have taken, and there's no success, of course, in their farming. So how then do we mitigate? Of course, we have tried to introduce insurance for agribusiness to safeguard this, but this is something that comes from time to time due to the way our weather patterns are. Renewable sector is also another area whereby we also face economic risks due to technological advancement and involvement in industry standards. So where we have outdated or less efficient technologies can result in lower energy production. We see reduced revenues from companies that may or could have been able to perform better. And also potentially then sometimes it does lead also to loan defaults. So we do try to manage this risk by resorting to financing renewable energy projects with our clients, so that as much as possible, they're able to give maximum output in their production. Climate policies also provide a framework for managing climate risks and supporting the shift towards low carbon models. However, sometimes these policies can also create risks for banks with exposure to carbon intensive industries. So this has to be managed well, has to be done in a phased-like manner. So if it is not handled well, we have been able to see that this also can lead also to a potential risk, as the value of the assets then tends to decline. And therefore this can lead to stranded asset risks and also potential loan defaults. And so at KCB, we have tried as much as possible to ensure that we implement the environmental and social due diligence through our environmental and social management system policy to ensure that all our business operations, all our lending, we take them through the environmental and social due diligence to be able to ensure that we can manage some of these environmental and social risks which are seen and also which are unforeseen. And also we try to make sure that even as we do that, it enables us to mitigate on areas that have potential risks. And of course, on areas that don't have potential risks, then we may have to decline a facility. But yeah, indeed, yes, we do have risk. And of course, yes, it can impact actually the balance sheet. Thank you, Sarah.
Thank you. And Judith, maybe we can just come on to some of the targets or the objectives that your institution has set in relation to climate change. We heard there a lot about the policies and the due diligence, etc.
Oh, okay. You'd like me to expound? Yes,
just a little bit on some of your institution's targets, maybe, you know, why you selected the approach that you have.
Okay. So basically, also one of the things also that we have done is to deliberately ensure that also we increase our green lending book. And so what we have done is also do a lot of trainings and capacity building for even our staff to be able to identify these risks and how to manage them, and also how to have engagement with customers so that they can transition them into a better way of doing business that accommodates renewable energies, and also ensure that also they safeguard the environment and also the society in which they live in. So we have been able to do quite a lot of training and capacity building for staff, and also including our customers, because if you don't have that partnership, then it's very hard to achieve the results that you want to see. So both must work hand in hand. We also try to make sure that we have engagements as industry with other banks to be able to see also, as we know that in most of our countries, the states would like to introduce things such as e-mobility. And we know that if it's not handled well, then we may have potential whereby it can be a loss to an organization or even to a business. So how do we then make sure that there's better engagement, there's better discussions with stakeholders to make sure that we have a better transition into better ways of embracing and managing our risks that we have.
Thank you, Judith. And I think that's really interesting to hear from a commercial bank. Obviously, it's very different when it comes to setting targets or climate objectives for a development bank. John and then David, I don't know if you would like to chip in on your experience of climate targets or objectives that you've been thinking about.
So Sarah, can I take this?
Yeah.
Yes, so in addition to what Judith mentioned, I think we are a development finance institution, and we've taken maybe larger steps to ensure that our financial intermediaries also adhere to various environmental and social management systems that we require them to operationalize. We see that in the sector, we see that banks or commercial banks have these policies and systems in there, but as to whether they are actually operationalizing them and also capturing the right environmental and social safeguards, and as well as providing targets for them. So at DBG, yes, we don't lend directly to SMEs or the private sector, but we lend through financial intermediaries. And one of the key things that we do here in response to ensuring that we don't just look at the risk, the environmental and social risk, but also the opportunities, and which I'll come there later, where we look at the climate financing and the green financing space. So one of the key things that we do is that when we are onboarding or finding a partner financial institutions, we have an eligibility criteria, in that if you do not have a dedicated team and also an operationalized environmental and social management system, you will not be onboarded. And the bank also have a program that we handhold our financial intermediaries through a period of 1 year to make sure that they are actually complying, as well as making sure that they integrate the system in their lending operations, not just beyond lending, but also in their internal operations. Now, so what are we doing at Development Bank, since we are not lending directly to the private sector? What we're doing is that we've developed a taxonomy, right? We call it a DBG Green Taxonomy, where we are socializing this with our financial intermediaries, which are currently 7. And what we are doing is that we have a list of eligible climate adaptation projects and its sub-projects, and also climate mitigation projects based on our priority sectors. So currently we have 4 priority sectors. We are lending to manufacturing, agribusiness, high-value services, and the tourism sector. So how are we working around this is that we socialize this with our PFIs, who are our financial intermediaries, so that they go through their books and explore how we can co-create products in which we have a seed fund that we want to amplify in the coming in the coming months, you will hear that we've launched a climate financing facility. We are not just setting up this facility just to lend directly, but also aligning these pipelines into outcomes and targets, so that we are not just lending to them, but also being able to capture the various greenhouse gases and be able to measure them over time. The bigger goal is explore an area where we are using these data for carbon assets market. So these are the things that we are working with our financial intermediaries, and we are in the process of launching it in the coming months. Thank you.
Thanks, John. And maybe David, can I come to you and just ask if you have anything to add in terms of the thinking at the AfDB on climate objectives or any targets that you might be setting?
Yeah, I mean, I think, the bank has made really strong commitments around climate change. And one of those is ensuring that all our lending is aligned with the Paris Declaration. I'm not quite sure by which year, but I think it's within the next couple of years. Now, for those of us within the bank that work within the financial sector, because like John, I mean, we don't lend, my department does not lend directly to SMEs or corporates. We are working with financial institutions. So it's really a similar approach to what John described, but if you like, at a continental level. And we have the added challenge that a lot of the times, we're working with relatively small institutions, limited capacity in fragile states. And we know that a lot of the countries that are seeing the brunt of climate change, bearing the costs of climate change, are really in fragile countries. So the question for us is, how do we help these banks to identify the risks, to take what is happening at a global level and adapt it to their needs, both in terms of risk management and also dealing with the opportunities. And that is actually one of the reasons why we are so excited about the work we're doing with AFAC, but I guess I can say more about that later, but I'll leave it there for now. Thank you very much.
Thanks, David. So maybe we can come on to talking a little bit about products in particular. Obviously, products for a development bank are quite different to those for a commercial bank, but yeah, it'd be great. Maybe, John, we can start with you, thinking about any of the green or sustainable financing products that you're bringing, do you envisage there being a good business case for this? Is it going to have a good boost to your P&L? Or maybe there are some challenges or barriers that you have in terms of green financing products. Be good to hear your perspective.
So thank you, Sarah. I think you are right. Development Bank, yes, we're incorporating green financing products to our current line of credits to our various financial intermediaries. And one key thing about what we're doing at DBG is that we've committed, 5% of our total loan book to climate adaptation and mitigation eligible projects. So you remember earlier I mentioned that in regard, we've listed eligible projects or eligible climate and mitigation projects that we believe that those are what we call our green pipelines that we are socializing with our PFIs. So one of the innovative things we are doing around this is that we are committed in using this 5% of our loan book, our entire portfolio, to use as a seed fund. So this seed fund will be used to be more of a seed fund for the main book. What we're doing is that we've developed products for renewable energy financing. We've looked at energy efficiency and agriculture financing. And also one key thing is looking at e-mobility, looking at the transport. And we are doing this based on our sectors that we are focusing on, because our 4 sectors that we are focusing on, we believe that are underserved, and that the bank is making, mobilizing financing to ensure that these sectors are well financed, and also they are realizing the various development outcomes that would push the private sector and its gap that is in there. One of the key things that we look forward to this is that, yes, as I said, 5% is one of the keys is diversification. We just don't put our funds in all, let's say, all these sectors that are actually okay, who are currently maybe environmental and social friendly sectors, but also looking at the long term. How do we work with our PFIs to ensure that we build capacity in risk mitigation, and also how we work together to ensure that stakeholders like our PFIs and also those end beneficiaries their objectives are aligned with our mandates of the bank. As you're mentioning, the various barriers that we see in our work, we see, as David rightly mentioned, there's a lot of knowledge gap, right? And there's the Herculean task, right? Is making and you in your presentation you said we identify the right consultancy services. We have the knowledge power at the Development Bank, and what we're doing is that with our partners, with KfW, World Bank, African Development Bank, and EIB, we're coming up with technical assistance program, more like an accelerator program, whereby we're talking with the financial institutions to build the products with them, and also build the knowledge. Not just building the knowledge and leaving it there, but also continuous hand-holding, and also looking at the bankability of their pipelines, and which is the most important thing. If the deals are not bankable for a commercial bank, they will not go there. However, we've also, coming up in the coming months, we are developing a bank guarantee. That's another mandate that we're doing to support businesses that are reluctant, or commercial banks who are reluctant to go into areas of this sort. So I believe that the basic, one of the gaps is knowledge. We need to have more sessions of this to build knowledge across Africa, and also making sure that, yes, we have the knowledge, we have the technical, but also we need the money. We need the money, and we have to stop making a lot of promises and talk, but we need to design vehicles and programs whereby we can come up with funds, where commercial bank will come together with African Development Bank maybe spearheading, where we develop vehicles, where we see that these are the list of commercial banks. Let's come out and develop a product. These products would then be channeled directly to these eligible green businesses, and therefore would accelerate our SDG goals. Thank you.
John, thank you. Judith, I'll come to you in a minute for a view on from a commercial bank, but David, maybe would you like to add anything around, you know, the challenges or the products that you're working on? And one thing I hear quite often is that one of the limiting factors in terms of the demand and supply for green products is that actually there's the kind of one of the bottlenecks is the development of the project pipeline, and that sometimes the demand isn't even there for the facilities that banks would like to provide. But it'd be great to get your take as well.
Yeah, thanks, Sarah. I mean, I think John hit the nail on the head. There's a lot of work to be done around knowledge, around understanding, and even basic things. One thing that really caught my attention was John said we've developed a DBG green taxonomy, right? We don't even have standard taxonomies. Right. So what may be a green project to DBG, with all due respect to John and his team, may not be a green project for KCB. And when you're sitting where we sit at the sort of intersect of the donor world, the global world, with all their standards and definitions, and finding that those standards and definitions are not perhaps not applicable in the African context, or may not be that relevant or even difficult to measure. That's one one issue that we see. The other issue that we see, quite frankly, is cost of capital. Right, cost of capital first, generally as a standalone in its sense, but also particularly with with respect to green projects or climate finance, or whenever you're asking a financial institution to do new things, because it's risk-based, right? So a lot of the discussion then turns to, well, we don't actually understand the risks properly, so the risk premium goes up and the cost to the final client goes up to the point where it becomes, quite frankly, unaffordable or doesn't make economic sense. So what are we doing? We're trying to establish a facility which would allow us to blend our commercial lines of credit to the banks with grant funding. We've done it in other sectors. There's an agri facility that was launched recently, which would allow us to blend our lending with the concessional funding and therefore reduce the end cost for the final beneficiaries. And of course, the problem is that the money is needed now, but these structures take a long time to develop. But I think, you know, there are already facilities. Finance is the end goal, yes, but I think we tend to underestimate the costs and the value of all the knowledge work, all the systems that need to be set up upfront. Because if you don't get those right, then the finance is not going to go to the right place and you're not going to get the right impact. So yes, finance is the ultimate goal, but let us not underestimate the cost, the value, and the impact of doing that upfront work, that upstream work. Why? Because, you know, we as AfDB, or even if you took, you know, the whole donor community, we are never, ever going to be able to provide all the funding that is needed to meet the climate challenge. Our work is to go in as a catalyst, so that if we were to do a credit line to KCB or DBG or whoever, even if it's $1 billion, what we want is for DBG, KCB to take the lessons learned from there and then apply it to its portfolio. So it's not about the 10 or even the 100 projects that our credit lines help to finance today. It is about how our partners, our partner financial institutions, take the learnings and then grow their portfolios. Like, very long answer to a very short question. So I'll stop there.
Thank you, David. And we'll be going to a poll in a couple of minutes, but we'll just hear from Judith first, whether you've got anything to add from the commercial bank perspective on products and the challenges, the demand, etc. And then we'll hear views from the audience.
Thank you, Sarah. So John and David already spoke about the issue of the capacity gaps that of course exist. Of course, limited pipeline of eligible projects. That's also something that we have observed. And also lack of standardized definitions and frameworks. And also we've seen even our own regulators also not understanding it well. So of course they cannot also put measures in place to be able to increase that aspect. So I think that lack of awareness, lack of understanding, not having even local consultants who can be able to guide and handhold in case you need to be guided. as an institution then becomes a big challenge. And that's something that we have experienced as one of the challenges. But again, even with those challenges, we still feel that, yes, there are still opportunities. And one of the things as a bank that we have done is to try and even do pilot projects for some of the activities that we feel can have scale. And we have done this with in the livestock farming area. We have done this in greenhouse farming. We have also done this in biomass production with the manufacturing sector. So we are looking at all the areas that we feel have quick wins and can be able to be scaled, that we can be able to do on a pilot and probably work with other partners to be able to scale. So those are some of the initiatives that we are doing at a pilot level so that we can be able to see if it can be able to generate interest for scale. The other part, again, we are looking at is ensuring that also we continue to support financial inclusion and sustainable agriculture to make sure that as much as possible, we can be able to administer off-grid energy solutions. The other component also is on natural resources. How can we promote sustainable forestry? How can we promote responsible mining practices and biodiversity protection? Because also in Kenya, we find we have the sea and the oceans. And so how can we play a role also in that so that then we can be able to improve livelihoods of our people who we consider as our micro SMEs. So yes, we do have the challenges, but again, also we are working around it to see also how we can manage that. And also in terms of also reporting. So we continue to do our disclosures and reporting. And of course, as we do that, we also mention some of those challenges we go through. And this also has helped even in terms of our relationship with our DFIs, like our IFC, our Africa Development Bank here. Sometimes as they read and see that, then they're able to come and say, okay, I think we can be able to partner together on this area for you guys to scale. So we have also tried just to make sure that as much as possible, the actions that we take, we disclose them so that then we can also be able to get partners who are also interested in that area to be able to scale some of the initiatives that are ongoing. Thank you.
Thanks so much. So let's now, Alain, if you can help us with the poll, let's hear from the audience some views on a couple of questions. So what are the main challenges that you are encountering to incorporate climate, whether that's on the risk side or the opportunity side in your organization? So hopefully the poll should pop up for you. Yeah, so we've got a whole menu to pick from. We've got lack of awareness, lack of expertise or resources, the data issue that always comes up, regulatory complexities, integration with existing risk management frameworks, a short-term focus and conflicting priorities, as we heard before, you know, the pandemic and energy security issues, etc., inflation, cost considerations or something else. So we'll just give you a few seconds to complete that one. Think about your main challenge that you're for you to incorporate climate risk and opportunity across your organization. Alan, how do the responses look? Do we have enough yet to display them?
Let's wait a couple of more seconds. We have only 37% of participants that answered.
Oh, okay, yeah, great. Well, we've got fabulous attendance today, so let's just give you a few more minutes to pick. Lack of awareness, expertise, data, regulation, existing risk management frameworks, not being flexible enough to incorporate climate, short-term focus on conflicting priorities or cost considerations. We know that it is costing banks an awful lot of money to implement climate concerns across the organization. So we know it's not cheap, whether you do it in-house or bring in consultants or a mix. Okay. Wow, well, we've got quite a diversity there of quite a diversity. I can see that people have picked a few. So I think the top one is data. The top one, in my experience, the top challenge is always data. It's very frustrating, and I'm hoping that in the next few years we have some real game-changing initiatives that's going to help us with that, with things like the climate data public utility project and other things around SMEs, etc. We've got lack of expertise and resources. That's a real big issue as well. There's so much capacity building to do and training. And then we've come down to the next roughly equivalent is other conflicting priorities and cost considerations. Yeah, I think nobody has resource or funds sloshing around waiting to be deployed on this very difficult topic. And then roughly equally, we've got lack of awareness, regulation, and integration with existing risk management frameworks. And I think that is really especially difficult with banking systems to incorporate climate. There's a big systems change element to it, which is difficult, and obviously regulation and awareness across the organization. Great. Well, let's move to the next question, if we could, Alan. So what would be the best lever to address your challenges? How could you best be supported? Is this really around knowledge sharing and education? So, training, case studies, conferences, or is it about a collaboration platform and network? We heard before about the GFANS Africa network. I'm hoping that'll be a real game changer. Data and analytics support. So the technical side of data and analytics methodologies. Research and innovation, so collaborating on new approaches, technical assistance and consultancy. So we do hear from many banks in less developed countries that is a real challenge. Or is it actually policy advocacy and engagement? One thing we're very mindful of in the Net Zero Banking Alliance is that banks can't do this on their own. They need the government to put in place a supportive policy environment that's going to make it easy for their clients to make a sustainable choice in their lifestyles or in their investments. Or is it something else? So please do tick one of those, and then we'll come to the answers. Thanks, Alan. Oh, right. Okay, so topping the poll again is data. That's well, at least that's consistent with the last one. So data solutions, but hot on its heels is the technical assistance and the consultancy. And then very close together, we've got knowledge sharing and education, research and innovation, and the policy advocacy side of things. Yeah, and also the collaboration platform and network. So basically, we've kind of got two tiers. So out in the front, we've got data and technical assistance, and then we've got all of those activities around education, knowledge sharing, collaboration, research, innovation, and then somewhat on its own is policy advocacy, which is such an important thing that I think especially we can do through alliances. So thank you so much for that. It's really interesting to hear your views from the audience. So I think we've only got about a few more minutes left. Maybe should we move to some of the questions from the audience? I can see we've got quite a few in the chat. If I can ask the panelists maybe to come, thank you for being on camera so we can discuss some of these. We've got one from Martin, which is around where is the finance provision which counters the usual response we get from investors and banks that the work is too early for us, by which they mean it's an innovative business model or innovative technology that's aimed at SDG 7, but it needs to be proven before they will commit their funds. Who's providing this patient money that's need to fund renewable energy mini grids in particular? So I think often when it comes to that kind of funding, which is maybe more risky and high risk and a bit more innovative, normally in the financial ecosystem, that's the kind of the role of private equity to take on that more high risk. But there's one project when I was researching for this webinar that I came across called Mobilist, which is it's an initiative from the UK government, from the Foreign Commonwealth and Development Office, which is looking at really trying to give seed capital to invest in new products and bring them to market, particularly for listing. So there are a few initiatives like that. I don't know if anybody on the panel wants to chip in particular on renewable mini grids or just high risk innovation for climate solutions.
Yeah, maybe I can say quite a few words. I think within the bank, as I said, we've committed to being 100% Paris aligned in the very near future. I think it's within the next 2 to 5 years, definitely. And so there are initiatives, but they would sit in the sector complexes. So, I know, for example, the energy department has products. They have funds that look at innovation. We have in the financial sector development department, we have a fund that allows people to test, to develop and test products. So rather than looking at sort of the finance, I think look at the sector and do your research. And I think it's very important. I think Sarah makes a very important point about the type of financing you are seeking and whether bank finance is actually the right solution for you. Thank you.
Thanks, David. We've got a question here from Judith Tyson, which is about how are banks going to interact with transition finance in high carbon industries, and will the Net Zero Banking Alliance targets disincentivize such financing? I think one thing that's come out from GFANZ has been some thinking around how we sort of have a framework for transition financing, and I think there's interest in categorizing it into 4 buckets. So one bucket is all around climate solutions, things which actually are going to mitigate or provide adaptation. So that's solutions. Then we've got clients which are already aligned to Paris, so they're able to show that their business model is already aligned to Paris, to the Paris Agreement. And then we've got clients that are in the process of aligning, and they probably need more attention because the bank needs to talk to them about how they're going to align, make sure they've got a robust transition plan, and then that's an opportunity for the bank to help them with their financing. But then the 4th category is probably, assets that can't transition. And there we're looking at, say, responsible retirement type activities, as we see in the JET-Ps, the just energy transition partnerships. There's one in South Africa, one in Vietnam, and one in Indonesia, where they're looking at innovative models to kind of retire assets early in order to mitigate those emissions. But I don't know if anybody else wants to chip in on how you're thinking about transition finance with those high carbon emitting assets. You know, one thing we're very mindful of is not just having a paper decarbonisation of the portfolio, but having real world impact. Does anybody want to come in?
Yeah, maybe I'll chip in there. I think for the bank, our position really is to say that we have to look at everything in the context of Africa's development needs, right? So yes, decarbonization is important, net zero is important, but you know, Africa is not going to industrialize without access to energy. That energy needs to be clean, but also, and that's why, you know, there's a lot of discussion around, you know, natural gas, for example. It's a fossil fuel, but if you look at Africa's levels of emissions, they're like, you know, 3%. So what we're saying is, let's look at all these things in the context of Africa's overall development needs, which need to be financed. I think there's a bit of a nuance there that I wanted to point out. Thank you.
Thanks. Anybody else want to chip in on that one? Otherwise, I think I should hand back to Marina to close it off, because we are approaching time. That went very quickly. But I'd just like to thank David, John, and Judith so much for all of your insights. Thank you. Back to Marina.
Thank you, Sarah. And I was looking at the questions. I think most of the questions were covered by the discussion in the panelists. Maybe we can take 1 or 2 minutes to answer a last question from one of the participants. So I will invite any participant to raise his or her hand if they want to ask for one last question. Otherwise, we can indeed close the webinar.
I can see a hand up from Jose Luis.
Okay, so yes, please, Jose Luis Fernandez, you can unmute yourself and ask your question.
Hello, good morning to all. It's a pleasure to be part of this webinar. First of all, I think Africa has the key of the hydrogen era. I am the CEO of H2 Green Mauritania SA. I'm also the CEO of H2 Green Iberia, and also the CEO of H2 Green, H2 Power Revolution. Okay. My question is the next one. Okay, it's going the African Development Bank going to support us, our invests, and also what about the relations of the countries in Africa, because we need to focus in to be in a good relation to have secure our investments. Okay. Also, we are going to help all the countries of Africa to grow and to be then, as I start, to be the key of a hydrogen era in our case. And thank you very much. We are here to support you. I think hydrogen era has begun, and we are here to be part of you. Okay, thank you.
Thank you, Mr. Fernandez Fontecha. So I think maybe David, the question since it's related to AfDB,
Yeah, the line was a bit faint, but I think he was asking about AfDB support. And I think probably what we can do is, because yes, we do support, we obviously do fund projects, but there is a process. So what I would suggest is that he gets in touch with me directly. We can share my contact details offline, and we'll see what needs to be done or what can be done. There's also actually a lot of information on our website, so you can go and see what are the key sectors, what are the priorities for each sector, what are the special funds that we have that may be useful in your particular situation. I think also there was a second question about regulatory environment, and that is sort of policy dialogue is a huge part of our work, right? Because if you don't get the policy environment right, if you don't get the regulation right, you're not going to get the full result. So we do actually dialogue actively and continuously with governments in our regional member countries. I hope that helps. I know it's probably not a very complete answer, but it's difficult to give a direct answer in a forum such as this. Thank you.
Thank you, David. May I ask the panelists if there are 5 minutes and we can maybe take one last question? Okay, good, thank you. Mr. Toabi, you can unmute yourself and ask your question, please.
Okay. Good morning. My name is Toabi, and I'm a climate finance person from. So I have got a concern. I would like to know if you have got a methodology in order to help us assessing climate risk in the structuring of the climate projects in order to get them funded by banks. Because now we are working in a program and we help some SMEs to get some financement into some banks and other financement offer. So I would like to know if you have got some methodologies in order to assess all the climate risk existing for this kind of project related to climate.
Thank you, Mr. Toabi. If I well understand your question, because you think a little far, you want to ask our panelists if they have some kind of methodology to better assess the risk of the projects.
Yes. This is my question.
Okay, thank you.
I'm happy to take a first go at that. I mean, because the situation is with climate change that the past is no reflection of the future, and the future is very, very uncertain. One of the key tools for risk analysis is scenario analysis. So you need to think about, in terms of the funding, the lifetime of the asset, what are the potential outcomes that we're going to see in terms of, are we going, if we were to have extreme warming and be following a 2.7 degree scenario, what would that mean for the asset? What would that mean for its returns? What would it change the life of the asset? All of those things, if we manage to follow an orderly transition to a 1.5 world, what does that mean? So I think scenario analysis and that kind of thinking is really one of the key tools for risk analysis. But it'd be great to hear from the others how they're thinking about it.
Maybe if I could come in here too. So another methodology is how are you putting up the structures in place to measure the greenhouse gases? I mean, having a methodology, so maybe tracking over the number of years. So you may have to simulate the low carbon or the low carbon tracking, so that you could be able to know that, okay, I'm financing this project and it's supposed to reduce this X amount of carbon. I mean, it's another way of justifying and also the realization of these projects. Because why are you financing these eligible projects? It's supposed to for climate action and also to reduce these carbon emissions. So another way of doing that is that looking at, yes, the development outcome approach, but also looking at the reduction in carbon. Thank you.
Thank you very much, John. So, and I think now it's time indeed to close the webinar. So I want to thank again all the participants for joining today. So as I said at the beginning, this is the second step of a series of webinar. So please stay tuned for the next webinar beginning of June, focusing on the insurance sector this time. I also want to thank the panelists today for the insights and for sharing the experience. So the question for this webinar was how are African banks are facing climate change? And what we can take away from this webinar is that there are some initiatives going on, both from commercial banks such as AfDB, but also from development banks. And it was really good to hear also from the feedback of the participants today regarding the challenges and the labor they need to actually advance the climate engagement. So we note that data, knowledge sharing, education, collaboration are the most important levers needed for the banks, and there are initiatives such as the AFAC presented by Dr. Also at the beginning of the session is here to address all these issues. So I will reiterate the invitation to actually engage with us on this important initiative. And also you have the presentation of initiative within UNEP FI. So thank you again for your participation today. And I hope to see you for the next webinar focusing on the African insurance industry on the 6th of June, as you can see on the slide. As I said at the beginning, you will see appear on your screen a satisfaction survey. If we can ask you to take some minutes to answer it, and it's very valuable for us to make sure that we will provide you with relevant content and services. Thank you very much again, and have a nice afternoon or evening, depending on where you are. Thank you.
Thanks so much.
Thank you. Bye-bye.